1310 WIBA and Ask the Experts with Wisconsin Capital Management online. WISCAP.com. That's WISCAP.com. Hope you've had a chance to stop on by the website. If you haven't been there, today's a great day to stop on in when you get to the office. Just punch in on your computer that WISCAP. Learn a little bit more about Wisconsin Capital Management. Also an opportunity there to dig in. If you want to make contact, give them a call and set up an appointment. Again, just head on over to WISCAP.com. That's WISCAP.com. Joining this week are Tom and Nate Plumb, of course, of Wisconsin Capital Management. Tom, how you doing this morning?
Oh, we're doing just great. It's still sad to see the summer start to turn to autumn here, or at least get a little taste of it in the weather, but it's a wonderful day in Madison, Wisconsin.
It sure is. Days are getting a little shorter, starting to notice that. Nate, how have you been?
Doing great. Excited to be on the show and with my dad again. So, yeah.
It's really exciting to have both of you along. And as we're going to break down this week, a really important question, which is understanding how your financial advisor, how they're getting paid. Where's that money coming from, and why, what that matters, and what does that mean for you. Before we get to this week's conversation, though, Tom, let's actually look back at some of the previous shows. We've really covered a lot of great, important topics for folks. They can definitely listen back at WISCAP.com as well as at the radio station website. But let's talk about some of those previous topics, and let's also talk about what brought along this week's topic.
Well, Shawn, we've talked about how your total return and how it influences your ability to meet your financial goals can be a factor of your asset allocation. It's also the time and the compounding, which again we call the eighth wonder of the world. And basically, if you're going to meet your financial goals, you have to have a plan. And when you have that type of plan, a lot of things can work for you, including how much money you set aside for short-term needs, midterm needs, and then allowing that compounding to work, especially for your long-term needs.
And Tom, one of the little tidbits you shared with me before this week's show was a really interesting study from Northwestern Mutual. What did that find when they looked into folks that work with advisors?
Well, I think we've seen a number of studies over the years that show that a lot of people have difficulty matching up their total return with the actual types of investments they're investing. And that's primarily because sometimes it becomes an emotional decision. But Northwestern Mutual indicated that in their study that most people seem to be well served when they have a financial advisor that's working on their behalf. And it gives them serenity, it gives them some confidence that their money is being used the way they want it to meet those financial goals.
Talking this morning with Tom and Nate Plumb. They come to us from Wisconsin Capital Management. The website, WISCAP.com. That's WISCAP.com, all one word, WISCAP.com. Love to have you stop by, check out the website this morning. Again, that's WISCAP.com. We'll get Nate in the conversation in just a moment. But first, one final thing, Tom. Let's talk about, there's all these different terms as far as wealth managers and those type of things. Kind of explain some of that and really what they are, and a little bit more about some of those terms there, Tom.
Well, I think a lot of people have been using these terms and sort of mixing them up when they talk about that they have a wealth manager or a financial planner or an investment advisor. There's also, of course, people who are traditional stockbrokers or insurance agents. Most of them are very reputable and trying to find the best plans to make their clients successful. But there is a real difference when you start talking about someone being a registered investment advisor, because the SEC finally determined that to say that about yourself and what you're doing, you need to be a fiduciary. And I know that's a term that sometimes is confusing, but a fiduciary is someone who puts your interests as a client above their own and acts that way. And that's very, very important for determining whether or not that person is going to be working exclusively on your behalf, or if they're working in a way that might be okay for you, but is very beneficial to them as the advisor.
And Nate, this stuff can get pretty confusing, can't it?
Yeah, it definitely can. And then sometimes even financial advisors are confused themselves because the terms have changed. Back in 2016, there was some legislation from the Department of Labor that tried to make some new rules, and those got enacted, and then the next president delayed them. Then the Fifth District Court, which is Texas, Mississippi, and I believe Louisiana, they said the Department of Labor overreached Congress's abilities. So for an analogy, it's like with the football season coming up for the Badgers. Mm-hmm. So essentially the SEC is the coach, Coach Fickle, and the Department of Labor is the referee. And this time they was kind of ruled the referee decided to add some of the plays to the coaching book, which to make the game better, but they said that was an overreach. So that was a kind of analogy of what happened. And then, as my dad mentioned, there was after that kind of failed with the Fifth District, then they made the best interest rule. So essentially, if you're regulated by the SEC, the Securities Exchange, that you are essentially a financial advisor, and you should keep your fiduciary should keep your the client's best interest at heart. But a lot of products are sold in different ways. So usually what advisors is most popular is called the fee for service. So essentially, if you have if your money grows, their fee grows, and so usually people bill you quarterly for that. That's the most common structure you see out there. But there's also things that are bought on commission, and those are usually insurance products. So like life insurance, whole life insurance, different annuities, and there the person selling you gets this cut, which could be up to 1 or 7% right away, and they get a check as soon as it clears. The agent does, and then they get to spend it. So sometimes that's okay, but usually, as you find in life, if someone is getting paid more to sell you something, they kind of want to upsell you and oversell you, and there's sometimes a trap into that. But so that's why you have to kind of be careful and figure out and ask good questions about how exactly the financial advisor gets paid. And I'm sure that they'll talk a very, salesman-y terms, but make sure that you understand and not just nod your head.
And Nate, with that, they should be upfront and be able to very clearly explain to you how they're getting paid, shouldn't they?
Yes, exactly. So they know how they're getting paid, and they should be able to articulate that very well for you. And 90% of the time that you shouldn't have an issue with it.
Talking this morning with Nate and Tom Plumb of Wisconsin Capital Management. The website, wiscap.com. That's WISCAP.com. This is Ask the Experts with Wisconsin Capital Management right here on 1310 WIBA. Talking this week about exactly how your advisors are getting paid and asking those questions, and how much you're paying for that advice, and of course the products that you invest in. And Tom, what is when it comes to a registered investment advisor, what exactly is that designation? What does that mean then?
That is a specific license that the SEC gives you to practice and call yourself an investment advisor. So prior to that, it was becoming almost a generic term where people said, oh, this is my advisor, this is my financial advisor. But the SEC required that anyone putting that in their title, that they have to be registered, and they could be registered with the state of Wisconsin under certain rules, but they have to be registered with the federal government or with the Security and Exchange Commission, and there's certain rules that they have to have. As we said, they have to be putting your interests as a client above theirs. So we've seen that as being something that once you match up people's goals with the people's compensation who are helping you meet those goals, you're much more likely to meet them.
Is there something too, Tom, with this? And we get a chance to talk with you and Nate each and every week, and of course your role as a chartered financial analyst and kind of understanding this. It seems to me like, and this is just a kind of a layperson's observation, there seems to be a level of commitment and education and kind of another level to it. Is again, there's a role for everybody, and I know people that do a variety of approach helping folks when it comes to saving and helping them grow their portfolios. Most of them are really good at heart, just have different approaches. There does seem to be and for what you guys do at Wisconsin Capital Management, there does seem to be another level of commitment to that craft, to that trade. Am I understanding that correctly?
Well, again, the SEC has various tests that they require you to pass to get a license to then put that title on your business card and to represent that you are a financial advisor. So there's specific tests that you have to take, and those will determine how you can interact with clients.
Oh, that's really good stuff, and really interesting as we talked this morning with Tom Plumb and Nate Plumb, of course, from Wisconsin Capital Management, the website, wiscap.com. That's WISCAP.com. Great website to learn more about Nate, Tom, and the whole team at Wisconsin Capital Management. You can also learn about Wisconsin Capital Management itself and make an appointment and start that conversation right at the website, wiscap.com. That's WISCAP.com. We're going to continue our conversation with Tom and Nate. We'll talk a little bit about mutual funds, where they fit into all of this, and of course, ETFs and other things as well. We'll get the details from Tom and Nate. We will do that next as Ask the Experts with Wisconsin Capital Management continues right here on 1310 WIBA. 1310 WIBA and Ask the Experts, hanging out with Tom and Nate Plumb of Wisconsin Capital Management. Online, wiscap.com. That's WISCAP.com. Hope you had a chance during the break to check out their website, get to know the guys. If you haven't done that, head on in there this morning when you get into the office. It's wiscap.com. That's WISCAP.com. Get to know Nate, get to know Tom. Also learn more about Wisconsin Capital Management as well. Talking this week about understanding how much and how your advisors getting paid, and the importance of you as a client fully understanding that as well. And Nate, what are these wire-based advisors and kind of the understanding there? What is their role in things like annuities and insured products? Where do they fit into all of this?
Yeah, they fit in. Usually, as a financial advisor, you're usually contracted with a larger broker-dealer like Goldman Sachs or Morgan Stanley, or you're contracted through an insurance company like Northwestern Mutual or Lincoln Financials or something like that. And that way you have a kind of a product pipeline. You can use their products and sell them as you get educated and trained on those. There is so many products. Wall Street is one very good at doing one thing very, very well, and that is creating new financial products. So that is the genius of Wall Street, which can be good or bad. So you have to kind of navigate through that. A lot of those products are commission-based. So as I said, so if you, for example, buy A-class mutual fund from someone, the salesman's going to take like 4.5% right away, and then you go on your merry way. Some of them are the commission structures are very confusing. There's B shares where the advisor gets a little bit at the beginning, a little bit at the end. Then there's these Class C shares where you get you kind of nicked just at the end, and so. But usually. In the world that we navigated, we prefer the no-load mutual funds, so there's no commission up front. So if you put in $100 invested is working for you right away. So that's usually mathematically the best way that we feel that we can help people.
I want to dig into that a little bit more in just a moment as we talk with Nate and Tom. Nate, the one thing too is when you were talking about working with some of these other providers out there, some of these products, is there like a uniform disclosure for us? I'm trying to figure out, well, am I paying 1% or 7%? I mean, is that universal, or how do I as a consumer, as a potential client, how would I know that, like what that rate is, or is it very clear, or sometimes can it get a little confusing?
It could be both ways. So you are required when anything you buy to see what the expense ratio is. So sometimes it's kind of clear. The advisor can tell you, it can show you, it's in a summary form. So usually you should be getting a prospectus or some kind of contract that shows that very, very clearly. And if you don't see anything like that, you probably shouldn't buy it. the sometimes it is kind of stuck in the legalese. But if they're going to email it to you in like a PDF form, just hit Control F and then try to put in fees, and then hopefully search it after. Sometimes those legalese documents can be over 100 pages, but it's important to know what your fees, and sometimes these insurance products kind of lock you in, and the lock you in term they use is a surrender period. So sometimes you have these annuities and you're stuck in there and can't change for, I've seen some 7-9 years. It's just up to the contract, especially with these insurance companies. So you need to be leery. So my dad and I are the philosophy is that your finances change, life events change. So you got to be flexible. So we're very leery usually of anything that gets you stuck and it's something that you can't change. And so that's how we kind of think of the world at Wisconsin Capital Management.
That's great perspective. As we talked this morning with Nate Plumb and Tom Plumb, not only are we getting a little financial tips, we're also getting some computer tricks as well. That Control F. For folks that don't know, if you ever have a big document, you want to find specific words, Control and F, and you can type out the word. It'll find it for you throughout the document. And really great, powerful thing there as we talk with Nate and Tom Plumb of Wisconsin Capital Management online, wiscap.com. That's WISCAP.com. Of course, Wisconsin Capital Management brings you Ask the Experts right here on 1310 WIBA. And Tom, I heard Nate there mention mutual funds, load, no load funds. What exactly is the difference there? And can that be, for example, a no load or a load fund be the same type of investment, or what are some of the distinctions and differentiations there?
Well, as Nathan mentioned, Wall Street comes up with some great ways that they can make money.
Yes.
So they can actually have the same mutual fund with the same name, but it'll have a different class of shares. And sometimes those class of shares will determine whether or not there's going to be a commission paid up front or behind, or what type of expense ratio is going to be within the mutual fund. So some funds, typically, the most inexpensive class is called the institutional class, and that one has a lower expense ratio and doesn't have a commission. But you still could have a transaction fee if you buy those funds through Fidelity or even a no-load type brokerage firm. They will charge a transaction fee for the lowest cost mutual fund. So it's very important to know how the funds themselves are charged, and those can be hidden, as Nathan said. You may have to search to find out exactly what the total expense ratio within the investment that you're looking at, especially right now we're talking about mutual funds. But then, as Nate mentioned, the other thing is you're paying someone to advise you to go into these different types of investments. And that's usually the fee that you see or don't see when someone says, we charge a management fee and it may be quarterly, like Nate said. Typically, we've seen across the country that runs from about 0.6% to about 1.2% for the actual management fee to determine what products you're going to be invested in to meet your investment goals. So again, you look at that aspect as being a very important part of what your expense ratio is, but then the other part is what the investments are, and is there an internal fee that you don't see? So when we say no load, that means no commission is paid to buy those mutual funds. And some mutual funds have a number of no load classes with different expenses. And of course, they're meant for different types of investors.
And Tom, when we talk about, and people hear about different commissions, those type of things, I know we've talked on previous shows about compounding. You talk about, a couple of percent difference in fees. Compounding, when it ultimately, has a reduction in your return there, ultimately then start compounding, it can actually have a quite substantial impact on your overall portfolio. Before we wrap, then I do want to ask you, Tom, a little bit about as we summarize, know what you're getting paid for. Let's talk about understanding the cost of advice. Should you be asking, for example, is somebody a fiduciary? And let's kind of talk a little bit about Wisconsin Capital Management and how that conversation goes when folks meet with you guys.
So again, when you talk about being a fiduciary, that means that that does not mean that you don't have any conflicts of interest. It means that you address those conflicts of interest in the benefit of your client. And so what we think is very important is that when you're meeting with your investment advisor, or you're meeting with Nathan and I or anyone at Wisconsin Capital Management, you ask, one, are you a fiduciary? What does that mean to you? How do you address fiduciary for your clients? And how do you address conflicts of interest? And if there are any, and there almost always is going to be some type of conflict of interest, because people are getting paid to give you advice. So you want to know how they can identify those conflicts of interest, and then how do they deal with them. Your total expense ratio is going to be very important, and it dramatically impacts your total return and the probability of meeting your success. So it's very important that you're comfortable with the people you're working with. You've defined what their role is, how they're compensated, and what the expense of the investments are to you. And then you can put that together and make sure that you make an intelligent decision about the advice you're getting.
It's a really important decision, and it's a great day to learn more about Tom, Nate, and the whole team at Wisconsin Capital Management. If you head on over to the website, wiscap.com. That's WISCAP.com. Nice button there. It says Contact Us. It's a great place to reach out and start that conversation. Get to know the guys and the team at Wisconsin Capital Management. While you're there, of course, you can ask all of those questions. They would love to share with you what they're able to do for you. Again, a great starting point is that website, wiscap.com. That's WISCAP. That's WISCAP.com, wiscap.com for Wisconsin Capital Management. Tom, Nate, it's always great seeing both of you. Guys have a great day, and we'll do it all again in a week.
That sounds
Thank
wonderful.
you so much, Shawn.
Take care, guys. And, of course, that website, wiscap.com. News comes your way next right here, 1310 WIBA.